Let's talk to Dave Harris. He is the CEO of InvaTrust Consultancy. David, very good morning to you.
Morning, Nick.
Right, let's have a quick recap. I asked you to come up with 2 different portfolios. You did part 1 earlier in the year.
We did.
I guess people can look back on the YouTube channel and take a look at that. What's today's subject?
Well, we looked at income and growth portfolios last time, and the movement forward now is to look at aggressive and defensive portfolios for those like-minded individuals. Now, since we did the income and growth portfolios, at that point, I think you just interviewed Justin Urquhart Stewart, and you were talking about, is the market frothy, is it overvalued? Well, it's gone up since then.
Yep, 1,000 points.
So if it was overvalued at that point, then we're a bit worried now. But look, I mean, I don't think that you can value certain markets, particularly when you're looking at the technology stocks now, to value those in the manner that we used to value markets, I think is very dangerous. I think we are looking at something completely different.
So industrial revolution, but if we're looking at it differently, that scares the living daylights out of me. It's different this time.
Well, it's different this time, and it's right that should scare you, because you shouldn't ignore history. But if you were to say to me, look, the growth that you've seen, say, in Amazon in the last 10 years, it's absolutely overloaded with cash. Is there anything to say that in 10 years' time you're not going to see a similar growth? You may not, but it's quite probable that technology will continue on its gravy train and its bandwagon. We're all going to use it. You know, look all around this studio. I mean, everything is technology, isn't it? And so I see no reason at all why we should be frightened of investing into technology today.
Okay.
But equally, in the shorter term, it wouldn't surprise me if there was a pullback. And if valuations were to drop a little from where they are at the moment, then that would mean a return to a buying opportunity for individuals going forward. So the first one that I looked at was, I mean, let's go look at the aggressive portfolio.
Okay.
So what do you look for in an aggressive portfolio? Well, I've highlighted a few things. Look, stocks that have simply got a high risk-reward ratio. You know, they're not your middle-of-the-road sellers of food or something like that. These are your technology companies, these are your biotechnology companies. They've probably got a high, most definitely will have a high beta factor in relation to the market. So for those who are a bit unsure what beta is, essentially if the market were to go up 1 and the company has a beta of 2, then the company will broadly go up twice as far as the market has gone.
Very good.
They're often an early stage of development. They have aggressive growth strategies. You know, we're talking about the technology companies that you see in the market. They also, you should be looking for turnaround companies that have had a poor time recently, but are they fundamentally a good company that's gone through a bad patch, through bad decision making or bad economy in their area of the market? Look for companies that are in those turnaround areas. Keep a very close eye on this type of portfolio. You should always analyse and be researching and looking at your portfolios anyway, but if you've got an aggressive portfolio, keep looking at it. Look at it every couple of days, every 3 days. Also, don't be afraid to take profits, and don't be afraid to take losses. If you've made a decision to buy something, but it halves in value very quickly, then that probably says the market knows something more than you do.
Yep.
And don't be afraid, it's a decision you made, you got a wrong decision. We all make wrong decisions in putting portfolios together. So if I was looking at an aggressive portfolio today, we've got the same £50,000.
Yep.
These are not recommendations, these are the sorts of things that I personally would be looking at.
Understood.
Right. So, NASDAQ.
Yep.
Best performing index by far over recent years. And I see no reason at all on any of the figures that I've seen to suggest that it's wavering. You know, it has all of the top technology stocks in. I would buy an exchange-traded fund, an ETF, and there are several of them about that concentrates entirely on the NASDAQ. So you replicate the performance of the NASDAQ.
Understood.
Scottish Mortgage Investment Trust, managed by a chap called James Anderson. Let's say he's a bit of a rebel, James. He very forward thinking. He picked up on this technology theme a long time before others did. It certainly isn't a mainstream investment trust. It's grown and its share price has grown dramatically. It invests in biotech companies, it invests in technology companies, it's in Tencent, Alibaba, Tesla, etc., etc. It's in all of these companies. And James was interviewed not very long ago, and they said, well, it's all very well being in these sorts of stocks, but what when the downturn comes? And his response to that was very simple. He said, in my opinion, it will be the next time there is a downturn in the market, it will be the traditional stocks that will see the big clear out, and many of them may fail, whereas these young, dynamic companies, in his opinion, will still move forward.
Okay, we like that.
Stagecoach Holdings. This is what I call a turnaround. Now, it lost the East Coast franchise along with Virgin Trains. It's had a very poor run, although I think it's got away with murder with the government, and Chris Grayling, the Transport Minister, has allowed them to walk away from this East Coast line, and they're probably several £100 million in profit by doing this.
Right.
That's not reflected in any share price or in any accounts within the company, but they've been thrown off the franchise for doing that line, and they're going back to basics. So they'll run buses, they'll run coaches, they'll do this and the other, and they previously were very successful at doing that. Rock bottom share price, good dividend, may not be maintained at its current level, but good dividend, good turnaround.
Okay. ITV, I see.
ITV, yeah. Well, now ITV making many, many more of its own programs and selling that product all around the world. Its advertising revenue was under strain, but in the short term, you've got the World Cup coming up. Undoubtedly, that will boost their earnings. New CEO coming into place. She seems to know exactly what she's doing. And I think, again, not only is it a turnaround situation, but it's also a possible takeover situation. I think one of the big media groups will look at that one day and probably take it out. And the final one, Marks and Spencer's. Now, we all know what Marks and Spencer's in. I mean, we're probably wearing something if we sat here. Going to close 100 of its stores. Says that it's going to do a third of its business online. My guess is that it's going to have to do more than a third of its business online as we move forward. But if it's successful in doing that, it sells what you and I of our sort of age want to buy. If it can get its fashion right for the younger people, then again, it's a good turnaround. The market liked the plan last week when it came out, and there was an immediate 5% boost in share price, but I perceive that might go even further.
Understood.
So that's my sort of aggressive portfolio.
Yep.
I mean, there's a lot in there that people would say, Harris, you're stupid. Why would you be buying that today? But it's be aggressive.
Understood. So let's talk defence.
Defensive, right. These stocks don't carry a high beta. Look for something that's somewhat isolated from the broader market. It's companies that make the basic life necessities that you and I want. You often hear portfolio managers talk about drinks, drugs and staples.
Yep.
So that type of thing. Companies that offer services and products that are always in demand. Doesn't matter if you're in a recession or if you're in boom time.
People still smoke, right?
Exactly. So for my portfolio suggestions there, first one I went for was the Foreign and Colonial Investment Trust. The oldest investment trust goes back to the 1800s. First started invested into American railways, I think I'm right in saying. It's still going today, sort of 150 plus years later. Now run by a guy called Paul Niven. He's followed an illustrious couple of guys, Michael Hart, who was well known to everybody in the city about 20 years ago. And so he's following in those very good footsteps. A global investment trust spread over multitude of different businesses, and now a sort of multi-manager type that Paul Niven oversees, but a good, solid, middle of the road.
Okay.
Personal Assets Trust. Now, there's one that will, if any Scottish viewers are watching, that they will know. It was originally run by a guy called Ian Rushbrook, who sadly died a few years ago. Now overseen by Robin Angus and the board. So the board is a self-managed fund. The board essentially make the decisions, although Sebastian Lyon is the overseeing fund manager. They have no hesitation in going 50 or 60% in cash if they need to. It isn't there at the moment. But I want to read you a little bit from their latest quarterly bulletin when somebody asked them a question when it said, you've got some pretty uninspiring performance. And he said, personal assets doesn't just aim to let you sleep easily, it aims to send you to sleep.
Perfect. Beautiful.
So you get a good idea of what they do. There is not huge turnover in the portfolio. Make a decision, stick to it, and look for valuations. They wouldn't buy on dips or something, as some managers do. But a very, very good portfolio to have if you want to sleep at night, as Robin Angus says. AG Bar, now they make sort of Tizer but more Brew. Again, it's a family-run company. It has no debt. It rivals Pepsi and Coca-Cola, certainly in the north with Brew. Not a particularly high yield on it, but a middle of the road, something that everybody buys, family-run company. You won't go far wrong over the longer term.
Understood.
Legal and General, one of the big personal finance players in pensions, etc. Everybody needs a pension. They're right in the midst of these workplace pensions, etc. With the fact that annuities have gone somewhat out of favour, then people are managing their own funds, and this is good for Legal and General because it's their funds that people are using as they move forward. Good dividend yield, over 5% at the moment, and something that I would have in the portfolio going forward. And the final one I looked at was British Land. Well, as it suggests, it's a real estate investment trust. It has commercial properties, shopping centres, warehouses, etc. As a real estate investment trust, it is required by law to pay out 90% of its rental income as dividend. Uninspiring, been hit by Brexit. There's all sorts of fears. But over the longer term, land values are not going to go down too much, I doubt. And British Land is one of the bigger ones, participants within that area. So that's the opposite to the aggressive portfolio. Either one of those will suit the different characters of people who watch these little shows.
David, on that note, thought-provoking as always. Thank you very much indeed.